Good morning. Welcome to the morning market briefing. Today is Tuesday, May 31st. Hope you had a great Memorial Day. Hope it was safe. We had excellent weather for the most part. It was a little bit cloudy yesterday afternoon, but just a really nice kickoff to the summer. And after a good week in markets, it was nice to see that. A little bit of reprieve certainly last week. We'll see what happens this week. It looks like futures are a bit mixed today. Bonds are selling off, but we want to start off with why maybe bonds are selling off. And a lot of that stems from inflation across the pond in Europe. This morning, we got inflationary data for the month of May. The consumer price inflation gauge came in at 7.5% for April. This time for May, it was 8.1%. So a big acceleration there, primarily driven by food and energy prices. But even the core CPI was up to 3.8% from a prior reading of 3.5%. So an acceleration there as well. And you're also accelerated on a month over month basis. On a month over month, you're up 0.8%, which annualizes out to about 10%. So overall, European inflation definitely coming in hot. I've seen a lot of commentary about a stagnating European economy, even from policymakers, which is a bit of a first for them. It looks like the ECB may do a 50 basis point rate hike, which would be the first in the ECB's history of doing something like that. Tom, as far as Europe goes, where is Europe in isolation? And then where is Europe relative to the United States from an inflation point of view?
I mean, they are way behind. I think their inflation, not only is it accelerating, but I think that it's going to continue to accelerate because unlike the US, they've done no form of monetary tightening. We're ready to kick off tomorrow with the unwinding of the balance sheet. We're looking at another two hikes in the interest rates from the Fed this month. And they haven't even finished their quantitative easing. And so they're way behind the eight ball. If the Fed is really crushing it on too late and they're starting to really hit the accelerator on the too little, Europe is so far. I mean, they're so far behind and they're doing so little that they're going to be in a world of hurt, I think, if they don't get started here in the next, 5 minutes, 10 minutes. They need to get something going. But that's going to be
the problem is they don't have as much leeway as they do in the United States because the growth is even lower in the United States and they haven't even started on the tightening.
Yeah, their inflation is just as high, but their growth is significantly lower. Not only that, but they're covering the Eurozone and not all of these countries are performing at the same levels. So it's going to be pretty tough on some of the poorer, less productive countries. The pigs, Portugal, Italy, Greece, and Spain, who are sort of the redheaded stepchildren of the European Union and can never get their proverbial house in order. But that's going to have an effect on us. The more Europe raises rates, the more we're going to have to sell off a little bit because there's always going to be a buffer in terms of rates between where we are and where they are. I mean, the German 10-year is at, as high as I can ever remember, and it's at 1.12 this morning. Which is ridiculously high for the German 10-year, which usually hovers somewhere around zero and has for, as long as I can remember, really. So we still present good relative value, but if everything else moves up, there's going to be demand flowing to those bonds, whereas you could never get any yield on a German 10-year. Now you can get a little bit of yield and there's going to be some buyers there because they think that's either an opportunity or it's a good investment. And that's going to suck some dollars away from buying treasuries. And so we're seeing treasuries sell off just a little bit this morning. It's nowhere near where we were just a few weeks ago. We're at a 286 on the 10-year, so up about 10 basis points from last week. But on the positive note, we've seen other areas of the bond market. We don't really own a ton of treasuries. We own some for some newer clients that want to do some cash management stuff. But munis in particular had an excellent month. We're seeing a big retracement there. People are seeing that those have sold off even more than treasuries and probably present a much better opportunity, particularly the tax status. So we're seeing some really strong buying in muni land, which is going to help us with performance. Going into the second half of the year, we're starting to see people file in there where they're filing out of things like treasuries. So, definitely a positive note there. Nothing really to be concerned about. But, if you're investing in Europe, you got to be really careful because they're just they're getting it from both angles right now.
One thing to watch on Europe too is the geopolitical implications of all this, because again, in the United States, we already see the implications of having one policy for 50 different states. which have subtly different economies. In Europe, you have dramatically different economies. You have some, I was going through the country by country. So 8.1% is the harmonized CPI for the entire European Union bloc. But you have some countries in there that are up 18%, 20% inflation. And then you have some companies like Spain or Germany or some of these larger countries around 5-7%. And so what you could end up happening is, when things get tight and when people start to get antsy, that's when conflict tends to arise. So we would just keep an eye on that. I'm not saying anything's going to happen, but that is something to continue to keep an eye on. Separately in Europe, if this inflation news and this inflation data point wasn't enough, what they are doing is they are looking to ban the purchase of crude oil and petroleum products from Russia delivered by sea. So if it's delivered by pipeline, you're good. So this was done to appease landlocked countries like Hungary and Slovakia. Germany, Poland also receives a lot of oil from pipelines, but they say that they're going to try to wean themselves off of that. I think this is potentially important. It's going to result in significant buying of oil in the near term. I think it's not due to go into effect until 6 months for crude oil and 8 months from now for petroleum products. What Russia's going to do is they're going to send the oil to Asia instead. But they'd have to take about a $34-ish discount in order to sell into Asia. So Russia will be hit probably to the tune of about $10 billion on this. But that's in the context of $270 billion of energy exports. And the Europeans are still going to buy Russian natural gas because there's simply no way to avoid doing that. So the EU really, I think they're really kind of hitting themselves on this. I don't know if they actually have an intention for this to go through. I think they're kind of hoping that the war in Ukraine will be finished by the time 8 months is up, and they don't end up having to go through with this, because it's going to be tough for them, especially in the context of inflation that continues to accelerate. Tom, any thoughts?
I just think they were never in a position to sanction Russia. I mean, I think Russia knew that when it all went down. I think that the European Union is really over a barrel here. And, if I think this thing's going to wrap up. I would hope that it wraps up sometime in the next 8 months. I think that there's a sort of a kernel of hope that there is a ceasefire. Russia takes over the Donbass region, and then that's a clear and easy exit ramp for them to save face and not have to continue to just throw bodies into Ukraine and hope that they can get something accomplished. So that's my hope, and sort of a probabilistic expectation, but I guess we'll see what happens. But I mean, Europe's just not in a position, and with inflation the way it is, this is not going to help.
Finishing off with the inflationary impulse that we're seeing today. So not only did we get the data point, we got the EU announcement on the ban on oil, but we also have China, which is beginning to reopen, and that's pushing up some demand. China, in addition to that, is trying to incentivize the production and sale of passenger vehicles. So what they're doing is they're cutting by half the tax on some lower emission vehicles, some lower emission passenger vehicles. This is for only passenger vehicles that cost less than $45,000. But they certainly need to incentivize some sales of vehicles, because in Shanghai, not a single car was sold in April. Almost all dealerships were shut down as a result of the zero COVID policy there. So, but we are starting to see China open back up. They're starting to try to stimulate the economy, and we're seeing that have an impact on inflation as well, and on oil and natural gas prices, which is having an impact on inflation and hence interest rates this morning. So it's all interconnected. Just follow the bouncing ball. In corporate news, Unilever will add Nelson Peltz to the board. Peltz's Trian Fund now owns 1.5% of the company. This guy's a big fund manager. The Trian Funds, they were invested in Procter and Gamble. They were invested in Danone. They were invested in Pepsi, Kraft, Cadbury. And each time he kind of comes in, wants some operational improvement, kind of move some businesses around, shuffle some business around. Unilever currently sells Ben & Jerry's. They sell Hellmann's mayonnaise. They sell Axe. They sell Dove soap. So they have a very disparate portfolio of products. I think this is a good move by Nelson Peltz. I think we were talking about it before the call started. I think it's very well timed, because if you're Unilever, you have a European cost base for everything that you produce. Well, if your currency is weak, that's a really good position for you, because you're basically, your cost structure is in a weak currency, and you can sell into somewhere like the United States for a lot more money. And so that helps your margins over time. And so I think that this is well timed by Nelson Peltz. I think that he definitely has some tailwinds behind him. It's a business that should be able to stand up to some level of disruption. It's more of a staples company. Tom, any thoughts before we hit the final story of the day?
No, I think this is a great move, and I think it's probably a good opportunity. He's got an unbelievable track record. I mean, nobody loves Axe body spray more than Europeans, in my experience. So he's going to do well there. But I think it also, on a macro level, goes to show that Brexit probably still net a positive for the UK. They're in a better position financially from a rates perspective, from an inflation standpoint. So Unilever is positioned well as a result, and I think that speaks to Brexit being a positive move still.
Finally, we're going to talk about there's a really important story, and that is President Biden's op-ed in the Wall Street Journal. He took out an op-ed. It's probably a 5-minute read. It's probably worth a read to understand how the current administration is thinking about policy. This was not only written by President Biden, I can assure you. There are a lot of people who had a hand in dealing with this. I'll hit you with the headlines and then we'll talk about it. So first of all, he really talks about what is the new normal. He says one of the reasons we haven't been able to really control inflation is 3 reasons. Number 1, Putin's war in Ukraine. Number 2, energy markets in quote turmoil. And number 3, supply chains that haven't fully healed. He said that in January 2021, when he took office, the recovery had stalled and COVID was quote out of control. And in the past 18 months, his administration has achieved quote the most robust recovery in modern history. His goal is to transition from quote recovery to stable, steady growth. That's twofold. Number 1 is bringing inflation down, and he acknowledges that that will result in a slowdown in job creation. He thinks that job creation will shift down from about 500,000 new jobs a month to 150,000 new jobs per month. In context, what that means is 1.8 million new jobs a year, which is about in line with the population growth of 0.9% a year in the United States. So it's basically saying that we shouldn't either expect the participation rate to increase, we shouldn't expect the unemployment rate to go down. We're going to be about status quo here. For context, again, the participation rate today is lower than it was in 2019. So essentially, it's going to be a little bit more of a humdrum economy than we had in 2019. That's what he's looking for, the reset. It comes in the context of the unemployment rate that'll be announced on Friday. So I don't know if President Biden has a little bit insider information here, if he knows the jobs number, which is they probably have already. I think it's a realistic assessment. I think that it's a little bit pessimistic. I would like to see a little bit more excitement about the economy, but there are a lot of problems, and he proposes some solutions for them. Number 1, he outlines 3 ways to tackle inflation. Number 1, he says it's primarily the Fed's responsibility. He is meeting with the Fed President Jay Powell today in the Oval Office. So it's primarily the Fed's responsibility. Number 2 is he says that they're going to invest in long-term productivity and basically trying to bridge the gap to make things more affordable in the short term. What does that mean? It means investing in alternative energy and releasing oil from the Strategic Petroleum Reserve. He has this housing plan where he wants to build more than 1 million housing units, but even that won't address the shortfall for 5 years. He wants Medicare to negotiate prices, cap the cost of insulin, all this stuff that we've heard time and time again, fix broken supply chains, improve infrastructure, crack down on exorbitant fees that foreign ocean freight companies charge to move products, reduce the federal deficit. I don't know if any of this stuff is really going to help inflation, to be honest. And I think it's not really going to help growth either.
Yeah.
And for that reason, Tom, I think that Biden is prepping us for a slower economy, and he's not really solving the supply side of the inflation issue. And I think that that's the economy we have to prepare for.
Yeah. And I think there's a lot of spin zone here, in my opinion, a lot of like blame shifting. I mean, really, I don't think the best way, beggars can't be choosers. I don't think the best way to fix the cost of oil is to continue to release the strategic reserves. I think the best way to do it is to incentivize oil companies to drill and not basically hang them out as a scapegoat. If you want someone to do something that benefits you, you don't just excoriate them in front of everyone repeatedly and blame them for these problems. When the problems are, you've made it extraordinarily difficult to drill, you've made it extraordinarily difficult to deliver and to refine and to make oil available to the consumer. And we want to have alternative energies that work. It's going to take current production standards, which take energy to produce. That's the long and short of it. You can't create solar panels using solar panels because you don't have solar panels. You got to use oil to make it. And I think that, it'd be a lot easier to make that conversion if we could get the price of oil down. It's a necessary evil. If you really want to change the world and make it green, you've got to use some fossil fuels, which are the current means of production to make those things. And so it's a lot of blame shifting, I think, on that part, is particularly in the oil space. But how are you going to crack down on exorbitant fees that freight companies do? I mean, they're all headquartered in Greece for the most part. I mean, what are you going to do? How does the U.S. government do that? How do they sanction companies who operate out of Greece? I mean, a lot of this stuff is just, it sounds good. People hear it, and if you don't know how the economy works, you think, oh, great, green energy, that's going to bring stuff down. Let's crack down on the bad guys. That's going to bring stuff down. But in reality, you don't really have the power to do that. You got to work with people. And this is a consistent theme where it's, blaming, we started all the way back with COVID. You got to get out there and make sure you're policing people and making sure that they're doing, they're wearing their masks and screaming at people at the grocery store who aren't. It's the same kind of thing. You got to go out there and deputize people to yell at people and yell at oil companies and protest. And it's not going to get anything done. It's just going to make things worse.
Tom, I'm curious as we think about the investment implications of all this, as you think about the Federal Reserve, my view is that we're tightening the pressure valve on the Fed. We're really squeezing them and making them do a lot of the heavy lifting. And I mean, it's just a matter of leverage. When you shorten the space and you isolate more, you're able to lift a lot less, or you risk pulling something.
Yeah.
And I think that's my concern, is that's what is increasingly on Jay Powell.
Yeah.
And I think that right now the estimate is that president of the markets is 10.5 rate hikes for the year. I think it's going to have to be more than that if we have inflation numbers anything close to what they're seeing in Europe.
Yeah. And I hear you there. I just think that the Fed is not, I don't think they have the intestinal fortitude to do it. We started talking about it last year, that they're going to have to raise rates. They're going to have to raise rates aggressively, repeatedly for a long time. And they've already started to back off of that. You're hearing Bostic say, we're probably going to pause in September, and that's not going to get us where we need to be. But I think a lot of that too is, Jay Powell's probably frustrated because he knows that he can't fix the supply chain, and, like you're saying, many hands make light work. If we could have teamwork on this stuff, hey, what are our biggest constraints right now? Oil's a big one. What's the best way to unconstrain oil? Find some more, find it here, and not be reliant on Canada or Iran or any of these, Saudi Arabia. Take responsibility. Let's get out there and let's find some oil. What's our next biggest constraint? Shipping. Okay, what can we produce here that we don't have to ship here? That cuts the middleman out completely. A lot of these things are look down the list. What are our main constraints? How do we fix inflation? And none of that is being done, but a lot of fingers are being pointed. And I think that equates to a much slower economy, because it's just, rather than taking responsibility, finding a form of leadership, even perhaps breaking with your party line, which is green, 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 say, hey, listen, beggars can't be choosers. We need some oil over here, or everybody's going to be in pain. I just think it's a poor leadership strategy. It's frustrating to see, especially if, you spend every day looking at these things and say, hey, these are the solutions that are most readily available to us, but we just decide not to use them.
Yeah, I agree with you, Tom. I think that from a portfolio management perspective, I think that it's important to remember, we'll deal with the economy that we have, not the one that we wish we had.
Yeah.
And I think that that's important as we think about portfolio management and just being smart in an environment like that. Even from on the personal financial side, not being scared, but being smart and sensible. The week ahead, we're going to have a really interesting view on where the consumer is. We have consumer confidence coming out later today. That's at 10 a.m. Tomorrow, we have ISM manufacturing as well as JOLTS job openings. This is job openings was something the Fed has really watched as a barometer of saying of being scared about a wage price spiral. Thursday morning, we have ADP employment. Friday morning, we have the big number. We have the unemployment rate. We have how many jobs were created in the month of May. That's going to be a critical one, especially in context of Biden's comments over the weekend. With that, we're going to leave it there. We did go long, but we will see you here tomorrow morning. A lot of data to parse through and a lot of updates, I'm sure, as well.